Absolute return funds are touted as making a comeback, bigger, stronger and wiser. But how on the money is this? Today we have journalist Fiona Harris with us, who has just completed an investigation into the sector. Thanks for joining us today, Fiona.
Hello.
Fiona, what exactly are we talking about when we say absolute return funds?
Absolute return funds, the aim of this strategy is to make a return in rising and falling markets. So it's an opportunistic strategy designed, I guess, to give returns in both those environments.
Does this make it the same as a hedge fund?
It does. Hedge funds are the other name that are used for absolute return strategies. And within this whole spectrum, there's a broad range of tools and strategies that are used to achieve that result.
Is there consensus in the definition?
No, look, a lot of people out there in the industry think the name absolute return fund is just a marketing tool. I mean, it almost sounds too good to be true. Absolute return, it sounds like a sure thing. But the emphasis, I guess, is again on the aim of the strategy, which is that return in rising and falling markets.
The absolute return fund sector really took a beating in the downturn. Is it really time for a resurgence?
Look, it is. One of the things that is really too hard to ignore at the moment is their returns over the past 12 months. There's an independent research group out there called Australian Fund Monitors who have had a look at the returns of over 225 hedge funds. And what they've found is about 80% of those absolute return funds have achieved or outperformed the ASX 200 over the last 12 months. So it's a significant result. 30% of those have achieved a positive return. When you look at the results of the ASX 200 over the last 12 months, you're looking at a negative 24% return. So very, very different returns, and like I said, just too good to ignore. A lot of the analysts are saying there are reasons why the sector didn't perform. A lot of the absolute return fund managers, a lot of the strategies were over-leveraged. A lot of them were overcrowded in similar investments. A lot of them were, I guess, using similar strategies as the equity markets. And as we know, equity markets took a huge turn, so these strategies hadn't performed well too. So there are reasons why they hadn't performed. But now the performance is turning, and what we're seeing in the last 6 months is a really different different result to the previous 6 months.
What strategies do absolute return funds typically use?
I mentioned earlier there's about 225 absolute return funds in Australia, the majority of which use the long-short strategy. So what that means is they buy long in rising markets and short in falling markets. There's a whole spectrum of different strategies out there. There's market neutral strategy, there's global macro strategy, and basically the essential part of all these strategies is opportunity. So making the most of a particular situation. There's a fund, for example, called event-driven funds. Macquarie has one. It's done really well of late. And what it does is it capitalises, I guess, on the cycle of corporates. So if there's bankruptcies, merger and acquisitions, it actually makes opportunities out of these events.
Is now a good time for investors to be putting money into funds like this?
I think the essential thing with this sector is it's not a timing issue. There are so many strategies that are used under the heading of absolute return funds. It's not a case of jumping in and out, which really raises the question of whether most investors are in fact informed enough to know about when to get into these particular funds and what strategy to use.
Are these funds typically a bit too opaque or complicated for the average investor?
Look, I have to say the analysts were saying that it's really a space where advice is needed. And also there is the fund-to-fund option. So for people who are really not experienced in this sector, they can get that broad diversification, which is really the key in an area that is particularly volatile, to have that broad diversification, and that can be achieved through the fund-to-fund approach. But interestingly enough, just over the past 12 months, a single manager in this space has performed a lot better than the fund-to-fund approach. So it can affect your returns to the way you choose to invest in the sector.
Thanks for your time today, Fiona.
Thank you.